Welcome to the Daily Update. This is being prepared Friday, April 8th, where we'll look at the action in the market today and then see how things look for Monday, April 11th. And in a nutshell, we saw a nice little rebound on Thursday that took us into the close. Well, we needed to see some follow through action on Friday, and that just did not happen. So we're back to more of things switching a little bit more negative, but there are a few of our indicators that have improved. So I'll go through that. So what happened on Friday? We had a gap lower open, and there was some initial selling. Things kind of started off a bit negative. The hope was that the momentum from Thursday might get carried over into Friday, and that just did not happen. As the day went on, we went lower and lower, but then we had a rebound and prices actually went positive. But after they shot up positive, there was like one little boost to go higher. Then they drifted lower and then they re-entered negative territory, and we ended up closing down 0.27% on the day. Is kind of not really what we were hoping for if things were going to turn back positive. Volume was below average, so we're back to kind of that game again. The technicals, believe it or not, some of the technicals actually improved a little bit after Friday's session, and I made note of that, and I'll show you that as we go through the charts. Of course, everybody's still talking about inflation and interest rates, and that seems to be the current fixation right now. If interest rates are going up, that's putting pressure on stocks, specifically the tech stocks and a lot of the growth stocks, because they have to borrow a lot of money to be able to expand or to put their products on the market. And if that could really feed into their overall profits. So, and then of course, the different geopolitical concerns. We're still looking at these inverted yield curves, but a few of them have now switched back. So I have to see how that goes. And then just the different debates that are going back and forth with oil. So what are some comments that we can make after Friday? The technicals are still weakening, but we did see some improvement, and I'll point that out, even though we saw a decline on Friday. The rising interest rates, they're really having an impact on stocks, specifically growth stocks. And that's why we're seeing that there's a real solid inverse relationship now between interest rates going up and tech stocks going down. Some of the yield curves are, and I don't know how to say this other than how I have it here, they're starting to re-invert, which means going back to normal, where they're in positive territory. That's starting to happen. And there is some suggestions. And if you look at the charts, when I get to that part, you can freeze that chart, look at it. You can suggest maybe that I email that to you, or maybe you can just look at it through here on the video, that look at what has happened to stocks immediately after we come out of an inversion. Typically, there's a really solid move to the upside. Well, if that is starting to happen, it doesn't mean it's going to happen right away, but there's usually that little push up after we have an inversion. The S&P went back below its 200-day simple moving average. So now we're a little bit more negative in that category. And one thing that last week, the transports had a pretty difficult week, but that was really carried over into this week. That's one of the big Dow components of Dow theory, and I'll briefly discuss that, where if the Dow is going up, you also want to see the transports going up as well. Well, with the supply chain issues, with the inflation, and you're hearing all this stuff about how much it costs to transport things, that's really biting into the different transport stocks. And then even though we're kind of bouncing around and having kind of a negative environment right now, sentiment is not really seeing that yet, at least on the index that we look at. The economic report that came out showed that wholesale inventories did increase. Now, think about that. If people make products or companies make products, and the idea is to make those products and then send them out to be sold. Well, if their inventories are increasing, that means that they're making the products, but they're just sitting there. They're not going out to be sold. So that could show some economic weakness overall. At the time I record this, the current marketvaluation.com charts have not updated yet. When I do the weekly video, I'll probably go through that. But the last reading, and probably will be the continuation of that reading, is that the stock market is fairly valued right now. Again, depending on how you calculate it. They use a different yield curve than some of the other folks. So that just shows there's a little bit of contradiction in there. As far as our trend condition, we've dropped below 20 and we are now in a trendless environment. Our bias, and I'll go through and show you the ADX. Our bias is negative because we're just not looking very good and we didn't see any follow through, and our momentum is now negative. So let's go back, look at the day's session. First, we look at sentiment where it didn't change. We had a reading of 48 after Thursday. Well, we still have a reading of 48 after Friday. People aren't really freaking out. Now, if we see a real solid down move, then yeah, you're going to see things really tip over to the right. But right now, there's really not a lot of fear coming into the market. And this just shows that we're pretty much midpoint along the way. The VIX actually declined a little bit. So on a closing basis, but we're still above 20 for right now. And then on the bar, of course, we're also above 20, but there wasn't a real big move with the VIX intraday. Then the VIX of the VIX, it also showed a bit of a decline, both with the bar chart and the line chart here. So if anything, fear seemed to subside a little bit, which is kind of interesting. Now, this is another thing that we're keeping an eye on. This is the ulcer index. When this is going up, that means that fear is increasing. And we're still not at any kind of a peak right now, but we have just crossed above the moving average that I have plotted here. So we need to keep an eye on that, especially if things continue to fall. And then I don't understand this. The AAII report came out on Thursday, and then I looked at it again, and there were different numbers on here. I also added some other numbers to give us some context, where individual investors are still kind of fearful, but they're not extreme fearful right now. Really, it's more that they're coming off of that extreme reading rather than falling down into a more fearful situation. Now, that could easily change if we see prices continue to go down. As far as our sectors, the value sectors really did the best, but since we had an overall down day, I sorted this according to what declined, which are tech, discretionary, industrials. Again, these tend to be more of the growth plays. You can kind of make a case for either side with the industrials, and communications. When we've been having difficult times, these are the sectors that have really been suffering, where utilities, real estate, staples, these are value plays, healthcare, materials, and the financial sector was up a little bit, with energy having the best performance on a sector basis, at least on Friday. And then this is what it looks like, with energy in the lead, followed up by utilities, and then healthcare, and then staples. So they're all positive since we had the all-time high, where you see discretionary, communication, and tech, as well as industrials and financials. They're still negative, and these are more growth-oriented parts of the market. So there's that battle just keeps going back and forth. One day growth wins, the next day value wins. Well, on Friday, value won, and our tech sector chart is just showing a decline. It was down 1.4%. Now, looking at inflation here, the CRB was up 1.25% and is still in an overall uptrend. Okay, so that just shows that inflation is really continuing to rise. And then the CRB is really outperforming the S&P 500 right now. And then here's the inversion of that chart, where the S&P is underperforming commodity prices. Then every week we come out with the fertilizer index, and it showed a bit of a decline, but fertilizer prices are still really climbing. And that's a key component of the economy, especially with Russia, Ukraine, because a lot of things, a lot of wheat and a lot of the products that we use in the US, they're grown in Eastern Europe. And well, before you put the products in the ground, you have to fertilize it, and then you have to do that along the way. And that could really bleed through into the prices that we ultimately end up paying. So even though it declined, it's still in a pretty solid overall uptrend. Now, I am including just what I'll probably do on Fridays in the Friday video. I'm sorry, for the Monday video that I record on Friday, is we'll look and see how things are as far as the interest rate scenario until we get closer to the meeting. Where right now there's the probability is at the next meeting on May 4th is that we will be at 0.75% to 1% with the interest rates. We're at 0.25% now. So that means 50 basis points up at that time. And that's pretty much what you're hearing now. That's pretty much what the market is expecting. If we start to see some economic reports that give us weakness, then this might really start to change. But it's really looking likely that they're going to raise interest rates 0.5% instead of 0.25%. And then here's just the historical chart with how those things have been gyrating all around right now. And then just to show this, because it usually updates near the end of the week, even though the Fed is raising interest rates, they are still continuing to add to their balance sheet. So again, I keep saying this, it's like having your foot on the gas and on the brakes at the same time. What they're talking about now is tapering, QT, quantitative tapering, where when we're doing this is called quantitative easing, where the Fed is in buying bonds. Well, when they stop doing that and they either let those contracts expire or sell them back into the market, that's when you'll see this line start to come down. As far as our technical alerts, not very many. The euro set a 52-week low, which at the very top, the dollar set a 52-week high. The S&P did go below 4,500 and the NASDAQ went below 13.8. And then we had a BPI that for the energy sector that crossed back above 80. So that's positive. When it comes back down and drops, that will be the second part of the signal and actually give us an overbought reading at that time. Intraday, we did gap lower and we really didn't hit a lot of the support and resistance areas all that much on Friday. We saw some initial selling. We ended up building a bit of a base right here, and that ended up being the low for the session, and we started to come back up. And then this was the one little spike up that we saw. Happened only over a 10-minute period of time, and that actually went above the unchanged level and took us positive. Well, then we just kind of drifted, tried to go a little bit higher, but that didn't work. So we drifted lower, and then we eventually went back negative. That's the dashed line here. Tried to have a little bit of a bounce at the end, but closer to the close, we ended up falling. So, and we closed right at about the daily pivot. In fact, just a little bit below it. So we wanted to see this price action on Thursday. Well, could it pick up here and then continue somehow on Friday? And that just did not happen. Here's the daily chart where, and if you see this, you notice that the high that we set was the high of the previous day right here. We couldn't even break Thursday's high. So there just was not a lot of buying enthusiasm on Friday. And then we were falling back down. What we want to watch for is, are we going to continue to fall and hit this pivot point? Or are we going to be able to break up out of this and then potentially deal with the resistance above where we're at right now? That's the key question. And if you see the volume down at the bottom, it does show that we decreased and we're below average on Friday. We're now down 6.43% from the all-time high. Not into correction territory yet, but we went in there before. And if we start to see another 3.5% decline, we're going to end up being back in correction territory. Growth really saw weakness where value saw strength on Friday. Here, this is another chart of the index ratio where it just shows that growth has really been declining. And here it shows where value is advancing when you compare the two with each other. And then the NASDAQ 100 really underperformed the S&P 500. Tech is just not looking very good right now, and a lot of the tech stocks make up the NASDAQ 100. Here's our pure value index. It was up 1.25%. So yeah, I think value won on Friday, where our growth index was down just about 2/3%, and actually fell back below the 50-period moving average, which is already in a downtrend because it's below the 200-day moving average. And then a ratio of the growth ETF against the value ETF showed about a 1.5% decline. So it was not a negative, it was not a positive day if you are a growth person, but there's still some improvement that we'll talk about. We are now in a trendless environment. We have dropped below 20. The lines are very close to each other, and this would generally lead to more of a choppy sideways market type of a thing. Now, if you notice back here where we were in a trendless environment, but the market still started to go up. Personally, what I don't do iron condors in this kind of an environment. I was watching the green line and it was going up pretty strong, even though the ADX was lower. What I do is I will sell spreads down below current prices because I don't want any of my upper strike prices to get hit. So that's a little more conservative approach. So we were trendless, but still had a pretty good upward bias at that time. We'll have to see what develops. If we continue to go lower or we go sideways, then you might look at doing some credit spreads above current prices, because if we really fall, especially with the negative backdrop that we have right now, you don't want those strike prices in danger of getting hit. That's just the way I do things, and something for you to think about if you even implement those kinds of strategies. Our Arun is really not changing. It's pretty much been flatlined all week, where it's seeing a decrease in buying and also a decrease in selling. No change with the decision point scorecard. As far as breadth, this is where we're seeing a little bit of improvement as we go through this. We saw a bit of an upturn based on price, but we're still going sideways to slightly down, and we're below the moving average based on volume. So that's a little bit more negative. Our advanced decline ratio, it continues to be above 0. So that's positive, but it is declining overall. This is also something that's a little more positive. We're seeing a little bit of an upturn with the new highs and new lows. We set a lot of new highs. Now, most of those were probably value stocks and stocks that had been getting hit a lot, but to see an expansion of new highs of this magnitude on a down day, that's kind of positive. Our accumulation distribution, yeah, it declined a little bit, but we're still above the moving average. Short term, we're still dancing right around the 20-day moving average right now. Our moving average steady, a little bit of an advance on the 20, a little bit of an advance on the 50, and flatlining to slightly down with the 200 steady. And then we're just kind of right in the mess of this whole spaghetti area with our 200-day moving average that we lost that. And this just shows a market in confusion, where when it gets all jumbled up and tangled together like this, it just demonstrates that there's not a lot of conviction either up or down currently. The MACD has crossed over negative now. The STO saw a little bit of a sideways movement and a little bit of an advance based on volume. The McClellan oscillator, this is also where we saw a little bit of improvement. The McClellan oscillator, even though it didn't go up very much, it's still staying above 0, so it's positive. The Stochk RSI continues to be extreme negative, where the Williams percent R still is declining and has not got to extreme negative territory, at least yet. The force index remains negative, but saw a little bit of a bounce on Friday. Intermediate term, we're starting to get down to the point where these 50-period moving averages might come into play. And then the 100, we lost the 100-day moving average. We were able to stay above the 100 exponential moving average, but again, this is not real positive action. You could say it's still all right because we're above the pivot currently. The PMO, even though they're still positive, they are rolling over. And based on volume, they've already rolled over. Based on price, they still have a little bit further to go. And then our PMO study actually saw a little bit of an advance with those that are rising, but those that are giving buy signals continues to decline. And we're seeing a bit of a decline with those that are actually above zero. This is another slightly positive thing. The BPI actually ticked up a little bit on Friday. And again, that's probably some of the value stocks that are coming more into play. And that's why you're not seeing a really wide bar right here. And here's just the longer term view of that chart. Moving average rainbow, we're right in the middle and trying to decide which way are we going to go from here. Stochastics, we're starting to get extreme negative short term. We're still negative intermediate term, and we're rolling over in our negative longer term. The summation index based on price continues to advance, but we're seeing a decline based on volume. We're seeing a mixed picture now with our momentum oscillators. Some of these have actually crossed over negative. Some of them are rolling over. And if we see another day or two of this, we'll see pretty much across the board negativity with all of these different momentum oscillators. The vortex is still positive, but really declining. The green line is going down with the red line going up slightly. The RSI still above 50. That's positive, but declined slightly on Friday. As far as our trading systems, we are still negative with the S&P based on the Elder Impulse system. The SPY, same things. Red bars mean negative. SAR is also negative because the dots are above. Our different charts, Heiken Ashi, still showing a lot of dark colored candles, which is more negative. The Kegi chart is red, so that is still negative overall, even though we saw a little bit of an improvement there. This is a little bit more positive. We did see a red box after Thursday. Well, it went away after Friday, so this is still more positive. Our three-line break is also showing a dark candle, which is more negative. Equivolume, just showing, again, nice red candle. And see, we just got up to the high, didn't even really exceed that very much. So this is what you could classify as an inside day, where neither the high nor the low exceeded the previous day. No change on the point and figure. And we're probably not going to until we see prices either really fall or really start to move higher. Long term, we've dropped below the 200-day simple moving average. This seems like a daily, it's like if you've ever gone from the US to Canada, where you've got a foot on, one foot's in America and the other foot's in Canada, and you're kind of leaning back and forth. That's kind of how it seems with the 200-day moving average. And it just shows a real lack of conviction right now. And the logarithmic scale chart is also negative. The moving average is at 44.92, where we closed at 44.88. So we're just not all that far below it, but we're still below it nonetheless. Then the mega caps, they were down 1.21%. They came right up to this moving average and have been falling ever since then. The special case, still, it's kind of rolling over a bit, but it's still trying to hang in there. Our moving average study, we actually declined a little bit on the 50. We advanced a little bit on the 150, and we're flatlining on the 200. As far as our broad market, here's the S&P and the mid caps, just showing that we're kind of getting back into the range where we have been for quite some time now. And then the Dow Jones Composite, it was up just a little bit, but we're right at the moving averages, and the moving averages are almost together with each other. And then this is a chart that I don't show all that often, where this is just a closing value for the Dow up above, and you can see how it bounced back up. But look at the transports, just down overall on a closing basis. And then the bottom, I include utilities as part of Dow theory. Some people don't agree with that, but I like to have all three. And this just shows the strength that we've been seeing in the utility sector. FANG stocks down 1.75% and pretty much matched the previous day's low. ARC also down 3.21% after looking like it was going to break out. The Dow kind of in between the 200-day moving average and the 50-period moving average currently, but still above the pivot. And it was actually up 0.4% on Friday. The diamonds are more neutral. They had been negative, but with the blue bar, that means they're a little more positive now. Small caps just not showing much strength at all. In fact, weakness, down 0.6%. Mid caps down not as much, but just below the moving averages, below the pivot, just not looking very positive right now. NASDAQ fell below the daily pivot and is below the moving average. Again, a little more negative. NASDAQ 100 right down below the pivot and right on the 50-period moving average. And then the Vixen actually declined a little bit, which is kind of strange. We had a down day with the NASDAQ 100 and the Vixen also declined, kind of what we're seeing with the VIX right now. The Qs, based on the elder impasse system, continues to be negative and is below the 65-period moving average, and the MACD is also well below zero right now. NYSE holding up okay right at the 200-day moving average, but we might lose that unless we see some follow-through buying. S&P 100 continues to underperform the rest of the S&P 500. The Wilshire also hanging a bit above this moving average, and we're still above the pivot, but we've got a ways to go to get back to the 200-day moving average. Internationally, since the KST is kind of slow, you can just barely see it starting to roll over with the S&P right now. And then all stocks, actually we're up just a tiny bit. So we're kind of in between the 50 and 200-day moving average right now. The world stocks, not including the US stocks, were down about 0.2%. Looking at some other measures, the dollar, which is, it was even above 100 there for a while, but it ended up being down 0.01%. But it's been showing some recent strength on the daily chart, and now here's the weekly chart as well. Oil is down below 100 now. It closed at 98.26. And then here's gold. It was up 0.4% with the futures contract, and it was up 0.63% with the ETF. But still, there's really no tradable trend going on here, unless you buy gold just to own it and you don't really care what the price is. And then here's the longer term view of the gold ETF. Silver was up a bit over 0.5% and is still above the 50-period moving average after seeing a golden cross not too long ago. And here's the longer term view of the silver ETF. Bitcoin's been having a little trouble. It's dropping down into the mid to lower 40s right now. And if we start to get down into the 30s, and then if we really get into the 20s, that's where things might get a little ugly. But we've been down there before only to see things bounce back up. Bonds, we went back, and I don't know, non-inverted, we're back into more of a normal situation in the 10 to the 2-year yield curve. We're still slightly inverted with the 10 to 5-year yield curve. We're right at zero right now when you compare the 30-year yield with the 5-year yield. And then the 10 to the 3-month, it's continuing to advance. And that's the one that currentmarketvaluation.com uses. And that's why they're coming up with a more favorable signal for how they treat the market as being more fairly valued. And then the one that Edward Yardeni uses, and this doesn't update as much, but it's still showing that the 10 to the Fed funds rate continues to be positive. And then I'm not going to go through all of this, just pause this and check this out and then see what happened when we went inverted, especially when we saw across the board inversions? What did stocks do right after that? Once they stopped being inverted. And then here's this whole conglomeration up here at the top as all these yields bounce around with each other. Internationally, we're just seeing a real climb in interest rates, except for Japan right now. And then bonds, we're seeing that breakdown in price. We've broken below these other levels of support. Are we going to continue to go lower? Because as long as these go lower, interest rates end up advancing. Corporate bonds are continuing to show weakness with the current yield at 3.55%. Junk bonds also down 0.59%. Generally follows the markets. Relative studies, just the gold S&P breakout just is not, it was up a little bit on Friday, but it's just not happening. It's going to need to really kick back into gear if we're going to look at this as something interesting. But the breakout between energy and the SPY, that continues. The ratio was up over 3% on Friday. And then looking at growth against bonds, not really much of a change overall. And then the tech against the SPY, it is showing that tech is really underperforming after hitting that moving average. And then looking at tech against the 10-year yield, interest rates going up, tech goes down. And we're seeing a pretty strong relationship between the two right now. And this just shows interest rates going up, tech goes down. Then discretionary against staples, discretionary seeing a lot of weakness as we're seeing some strength in staples right now. And then comparing the S&P to the 10-year yield just shows that the S&P is underperforming the rise in interest rates. And then our low volatility stocks, they were actually up a little bit, 0.19%. And then the ratio between the two is showing how growth is really outperforming value when you compare the two ETFs with each other. So what's our outlook? The technicals are mixed, with some being negative, others are weakening, yet there's still others that are improving. Not much, but we're seeing, especially with the new highs, new lows. I saw that and was a little bit encouraged by that, but we're still looking pretty negative overall. We're still in that intermediate term range. The daily battle between growth and value continues. We still have some yield curves that are inverted. Will they stay that way? Or are we going to be able to break up out of that and see all of the yield curves go back positive? We still have the oil issues and the supply chain issues, which could feed over into our own economic issues. On Monday, there's really no economic reports coming out. We still have all the things going on between Russia, Ukraine. The China lockdowns are still happening. That's what's biting into the transports quite a bit because of the supply chain issues. We're going to keep an eye on the yield curves, and then we always are keeping an eye on oil as well. So what are some of our scenarios right now? To go down from here, scenario A is kind of what's being played out, rising interest rates. If rates go up, stocks tend to go down, and then we're keeping an eye on the yield curve concerns. We're seeing internal weakness, and we're also seeing some breakdowns in the broader markets as well. And then the technicals, and there should be an S there, technicals weakening, and there was just no follow through buying on Friday. If we were going to really have something substantial, it did not happen. So that points more to the negative scenario playing out after Friday. If we're looking to go up, we do have this positive backdrop after yield curves re-invert or go back to being more normal. And looking at that chart, spend some time looking at that, and you'll see that once the curves get back to normal, we typically will see some kind of a rise. Doesn't last a long period of time, but we do see a pretty healthy bounce after that. As far as our oscillators, some are positive and showing a little bit of improvement, but others are turning negative or weakening. And then we're kind of bouncing around between a lot of different moving averages, either providing support or providing resistance. And now scenario 3 is where we're at right now. The ADX is below 20 and it continues to decline. So until we see a big move, we're probably going to see a real slowdown in price movement and choppier type of price movement as well. So what's our overview? The S&P is weakening and turning negative. Short term, it's more mixed and weakening with a little bit of improvement that we're seeing. Intermediate term, positive but weakening. Our oscillators, some are positive, but others are just about ready to roll over. And then we have this game between support and resistance with some of the moving averages. And then we are negative now because we closed below the 200-day simple moving average. And then here are just some of the different videos. I'm doing the daily video update right now. I'll post the snapshot video soon, and then I'll prepare the weekly video. I'm probably not going to have a chance to do any of the other videos this weekend. So thank you. I hope that you're enjoying the baseball's opening day has finally come and gone. Have a great weekend, and I'll prepare another daily video after Monday's session.